Welcome to the Montgomery Small Cap Management Series. Today we have the CEO and CFO of National Storage REIT. We have Andrew Catsoulis and Stuart Owen. Gents, welcome to the series.
Thanks very much for having us. We're thrilled to be a part of the program.
Thanks, Gary.
So why don't you introduce National Storage and its strategy?
Very happy to do that. Thanks, Gary. So National Storage has essentially been around for the start of the business myself 25 years ago, together with my wife. We grew as similar tale to many storage businesses in the US. We grew organically through development initially, and then subsequently through making acquisitions for a number of years until in 2013, we made our debut on the Australian Stock Exchange. At that time, we had 60 centres, roughly half of which were owned outright and half of which were held in a JV type structure. Roll forward 7 years and it's been a fantastic growth story for us. We now have over 210 centres during that period, and around 98% of those centres are now owned outright within the one structure. So it's been a fantastic journey for us over the last 7.5 years in our post-listed structure.
Andrew, Stuart, can you talk to me about the market structure and National Storage's specific strategy to take advantage of that?
There's roughly 2,000 individual storage centres in Australia and about another 400 or 500 in New Zealand. We're the largest player in both markets, in both Australia and New Zealand. Of those 2,500 individual storage centres, roughly 75% of those are owned by individual mum and dad investors, small super funds, privately run super funds and small syndicates. So with us being the largest owner-operator in those two countries, only 25%, including our approximate 10% of the market, is held in the major operators' hands. So it means that from a ongoing aggregation perspective and a growth perspective, there's still almost an infinite pipeline of existing centres that we tend to grow from. Our core structure is centred around what we call our 4 pillars, and that includes organic growth. So from an organic growth perspective, we have around about 100,000 square metres of capacity, built capacity already in place that we're continuing to fill as we speak. Our second key pillar is acquisitions. From an acquisitions perspective, there's roughly 2,500 storage centres in Australia and New Zealand. The largest 3 operators own less than 25% of those centres, us being the largest with approximately 10%. So from an ongoing acquisition perspective, our acquisition pipeline of mum and dad type operators is almost infinite. The third key area of growth from our perspective is development and expansion. So from a development and expansion perspective, we continue to focus on building high quality storage centres in key locations where we see infill opportunities within existing markets and into new markets where we see demand for new storage centres exist. The other part of that, of course, is expansions, which just involves us value adding to many of our existing centres where the opportunity exists to do so by increasing the amount of actual floor space at each centre. And then finally, the fourth key pillar of our growth from a strategic perspective is technology and innovation. And I'm happy to talk a little later about how we've used technology and innovation to the business's advantage, particularly over the most recent challenges presented by COVID.
It's probably worthwhile talking us through how you use technology in your business to drive those returns you mentioned.
I'll start with the revenue management perspective of it. So we have a revenue management system that we've implemented that effectively looks at supply demand characteristics and uses AI sort of developed algorithms to forecast what it expects supply and demand to be doing, and tries to price accordingly to maximise revenue across the centres. It works on effectively a unit by unit basis, so it's very, very granular in how it works. It enables us to price units for the market at to maximise our conversion rates in our revenues, all designed about increasing revenue across centres, effectively at an individually centre basis and again in unit sizes within those centres. I think one of the other things that we've done very successfully over the last 18 months is upgraded our website to what I'd argue is a market-leading website, not only in Australia, but probably across self-storage around the world. And the ability for customers and potential customers to get on that website, choose their unit, book, pay, and effectively turn up at the centre and move in without the requirement to talk to anybody. And during that process as well, you can take out insurance on your goods that you're about to store, and also buy your packaging and type of materials that we will then have delivered to your home. So you could actually be sitting here as I'm speaking to you, Gary, booking storage, ordering your materials, and they'll turn up on your doorstep probably tomorrow morning, and you can pack and move in.
Very good.
The third one we also will just briefly touch on is that from an individual tech and innovation perspective, Gary, we've taken the opportunity to build Australia's first completely automated storage centre. So that works on Bluetooth technology and a mobile-friendly app on your phone. So you can turn up, further to Stu's explanation of what we call the contact-free booking and move-in process. You turn up, you input your individual access code, and then you'll be guided by Bluetooth to your unit, and you'll have Bluetooth access, automatically unlocking your door and relocking it on your departure. So again, completely hands-off, contact-free move-in as a result of this automation that we've implemented and that we're rolling out to future new builds. Actually, as we speak, we have a number of those in the pipeline.
Sounds very interesting, fellas. Well done. Now I'm going to move on to a discussion about what you're seeing out there in the market today. And one of the things that I know that I was positively surprised about was the resilience and strength of not just your business, but the sector during COVID. I think the whole market's possibly surprised about the performance of the storage as an asset class. So perhaps reflect on that and talk to us about what the journey through COVID was like, and specifically through that key industry value driver of RevPAM, which is the revenue per available meter, or the performance of the assets in terms of the revenue that they can generate. So paint that picture for us, if you will. Sure.
I'll give some initial color, and I'll ask Stu to drill down in more of the specifics as our CFO. So look, from a COVID perspective, of course, many businesses faced significant challenges. We were fortunate enough to have lobbied both the relevant governments in Australia and New Zealand. We were characterised to fall within that essential service provision component of the economy. So whilst we don't directly provide an essential service, we support a number of the essential service providers, such as the PPE suppliers, the emergency response suppliers, many of the technicians working at our hospitals and other critical infrastructure and so forth. So our centres remained open and trading through the whole of COVID. What we saw was a phenomenal uplift in utilisation of the centres, both from the perspective of people wanting to have some secure off-site storage outside their home for various reasons. And then as things started to gradually open up in Australia, what we saw was this surge in consumer spending, because as you probably know, Gary, Australians are great travellers, and being locked away at home probably wasn't working so well for many of them. So they went out and bought a lot of consumables, home equipment, gym equipment, travel items, leisure items such as jet skis and caravans and cars and so on and so forth. And what happened was all of that hobby and leisure equipment needed a home. All of the people doing DIY projects needed to place some of their household possessions into storage while that was going on. And the surge in new house development that we're seeing off the back of COVID is continuing to fuel that demand for storage. So we've actually seen an enormous surge in demand off the back of COVID, and that has been assisted, of course, by the innovations that we've brought to the market in terms of contact-free move-ins and the tech and innovation. Stuart, would you like to give some specifics on that uplift?
Yeah, certainly. So, what we really saw during the first quarter of COVID, also that sort of March through the June period last year, we saw our occupancy drop by about 3.5%, which is not, disastrous or significant in any way, shape, or form. But during that time, we still maintained over 99% worth of revenue collection. So our cash flows were remarkably stable and resilient through that period. And we then come about June, and from June onward, as Andrew mentioned, we've seen significant growth in occupancy, and we've also seen rents continue to increase and recover very strongly, to the extent that our rents now are probably about 10% higher than what they were in January pre-COVID. So that has significantly contributed to increased revenue and increased RevPAM and the strength of the underlying businesses. From a storage perspective, our operating costs are relatively fixed. So every time we can increase revenue, the bulk of it flows to the bottom line. So that's one of I suppose our key advantages on a go-forward basis, as Andrew mentioned, is we've got 100,000 square metres of occupancy still to fill. Once that fills, that revenue effectively falls all the bottom line and effectively into shareholders' pockets.
And just to put that in perspective, Gary, we've actually seen well in excess of 100,000 square metres, or approximately 10% growth in same-store occupancy over about the last 9 months, since our financial year runs from July 1. So from July 1 through to the end of March, roughly 100,000 metres plus of same-store occupancy growth, which is quite extraordinary.
Okay, gentlemen, thank you so much for your time, and good luck in running the business for us. That was a great run through. Thanks for your time.
Thank you so much, Gary, for taking the time to speak to us. We're very, very grateful of all of our investor support and potential investor interest. So thank you again for having us on the show.
Thanks, Gary.